Welcome back, everyone, to the Great Retirement Debate. I'm Ed Slott, joined by Jeff Levine. Hey, Jeff, how's it going?
Good to be with you again, sir.
Yeah, and today we're going to talk about something we get asked about from time to time, the Roth IRA. We talked all about it, but this is a different scenario. People have a Roth IRA. Should I tap my Roth IRA funds early? Now, we both know the Roth IRA is the greatest account that's ever been created. There's nothing better. It grows tax-free for the rest of your life, no RMDs, income tax-free, I should say, and even 10 years beyond for beneficiaries. So smart thinking would say you want to hold on to that money. It's growing, compounding, accumulating, snowballing, absolutely income tax-free. Why would you touch it? So that's the question.
All right. Well, I think you said, should you touch your Roth IRA early? So
Early.
let me turn it back to you and ask you a question. What's early?
Well, that is the question. Early might be, some people might think early even before 59 and a half. That could
Sure.
be early. I've had people that tapped it in their 90s. I'm thinking of one client years ago, tapped it in his 90s and says, well, I'm going to touch it a little early because I need it for certain things, but I really wanted to leave it to my kids intact. It's been growing. So I'm going to cut into it early. Actually, it was a great estate planning move. This is a guy in New York that was smart. One of the clients that actually listened to me years ago that wrote the check because nobody wanted to write that check for big Roth conversions early on. Even our both profession CPAs, a lot of CPAs weren't on board with that. They say, why would you pay taxes before you have
A
to?
lot of them still aren't. We have those discussions all the time.
All right. So he was one that actually listened and he wrote the big check. It wasn't even that big. I think early on he converted, I don't know, 500,000. It's, that is a big item, but he did it. He saw
Big check in the early 2000s. Yeah.
yeah. So he did it. And then he was up to, I think when the time he called, he was in his 90s, one of my old estate planning clients, who I believe is still alive. When I used to do the estate planning, I was in my, say, 30s and my clients were 70. Now I'm 70 and most of them are dead, except for this guy and two others. All right. So he called me. Actually, his son was on the line too, because he realized he had a New York State estate tax problem. His Roth IRA was up to $8 or $9 million. Unbelievable. All growing because he made that investment. The guy listened, made that investment in taxes, which is not even a blip on the screen anymore, right? And it's
Mm-hmm.
$8 or $9 million. But he realized that he could lose $1 million or more in just New York State estate taxes. I'm making that clear because, even though the federal exemption is larger, some states have a lower exemption or
Yep.
so most states are state estate tax free, but we still have
Yeah, about a dozen or so states with a
yeah.
state estate tax still. That's lower. Yep.
And then you have like the worst states on earth, like Oregon. Hopefully, not to insult anybody, but you only have a 1 million estate tax exemption. You got to do something. Tell them to watch the podcast here. Do something over there. So anyway, he was worried about it. And his son told me, what can we do? And basically I said, well, that Roth, he says, but I was holding that for my son. I said, give it to him now. Give it to him. I said, yeah, take $5 million out. We decided that would be because he had other assets too.
Mm-hmm.
I said, take $5 million out and give it to your son. He said, what? What about the taxes? I said, there are no taxes. You're taking it out of your Roth IRA. It's tax free. Oh, what about my son? Doesn't he have? No, there's no tax on gifts. New York State doesn't have a gift tax. He couldn't, even the son couldn't get around the fact, wait, just take $5 million out of my
Yeah.
Roth and give it to my son. And nobody cares, no taxes. Yes. So that was a great estate planning play because he lowered his estate. And I believe he's still alive. He probably built it back up again somewhat, but still, that was a good move. So in his mind, that was early. I'll give you another
Yeah.
situation early on the other side. And I know you've written about this, so I'll turn it over to you. You've written articles I've seen over the years. I know you wrote for us and you even addressed it at some of our elite advisor meetings about using a Roth IRA early when you use it for a child's education. You want to talk about that? That might be a good
Yeah.
early use.
Yeah, absolutely. Yeah, I can think of a couple of times when, to me, the two definitions of early would be before 59 and a half, and the other one would be before you've run out of other money. Because a lot of people say, the Roth is the last thing you ever touch. So those
I
to me are
say
like the
that.
two. Yeah, there you go. Well, some people, Ed. So let's talk about those. Look, first for college education, oftentimes if you're looking at saving for a child or another loved one for college, the first account that you turn to is, let's say, a 529 plan account. And there's obvious reasons. It's a dedicated account for that. In many states that have an income tax, there's an income tax break at the state level, not the federal level, but at the state level, there may be an income tax break. And if you use the money for qualified higher education purposes, and actually now as we sit here, that those definitions of qualified expenses have greatly expanded over the years, but it's tax-free. The challenge, though, is like, what if you don't use those dollars for education purposes? What
Right.
happens then? And it becomes very inefficient, potentially from a tax perspective, to take those dollars out. There might be income tax cost on the earnings plus a 10% penalty. Plus, at the state level, they may recapture or take back any benefits that they gave you before in terms of state income tax deductions. So that can take a potentially tax efficient tool and make it a somewhat tax inefficient tool. With a Roth IRA, if you were to instead potentially save in the Roth for college education, if you are 59 and a half and you've had a Roth IRA for more than 5 years, everything that's in your Roth is tax and penalty free for whatever you use it for, including education. Of course, somebody listening today may say, well, I'm not going to be 59 and a half yet. I'll be younger when my kids go to college. Well, there are a couple of things there. One, any contributions that went into your Roth IRA could still come out tax and penalty free at any age for any reason, again, including education. Two, if you converted any money, any conversions that were made more than 5 years ago, so if you do this 5 or more years before your child goes to college, any amount that you converted can also come out tax and penalty free for any reason. And on top of that, the other thing you could do is you could have your child take loans, and you could let your Roth IRA continue to grow, and then you could simply use that Roth IRA to help pay down that student debt, perhaps after they graduate college or when you do reach the age of 59 and a half and everything is tax and penalty free. So there's a great thing there. The other thing I would bring up too, and I sort of alluded to it there already, Ed, is that pre 59 and a half, that's generally the magic age for being able to access your retirement account penalty free. But the way the tax code works is the 10% penalty in general is only assessed on the pre-tax portion of a distribution.
Right.
So to the extent that there are after-tax dollars, you generally don't have the 10% penalty. That's why you can take out your Roth IRA contributions at any time, tax and penalty free. They're tax free because you didn't get a deduction for them. They're Roth contributions, and they're penalty free because they're after-tax amounts. But without any sort of rule that sort of backstops this, it would create a little bit of a loophole. For instance, if someone wanted to tap their IRA money, a traditional IRA money, and they wanted to take out $100,000 at, let's say, age 45, you could, instead of taking it out of the IRA, convert the IRA today to a Roth, and tomorrow take the money out of the Roth where it would be tax-free and in theory would not be subject to the 10% penalty. So as a way to prevent that sort of quote-unquote abuse, Congress created a rule that when you make a conversion and you're under 59 and a half, the general rule that says if you are taking out tax-free money, the 10% penalty doesn't apply during the first 5 years. Or stated a little bit more simply, as long as you wait more than 5 years after making a conversion, whatever you converted is able to be taken out without a penalty. So if you're 45 and you convert, when you're 51, whatever you converted can come out, not the earnings, but the conversion amount can come out at any time, tax and penalty free for any reason. So some people are lucky enough to retire early. They may want access to their retirement funds prior to 59 and a half. They may not want to pay a penalty. There are a couple of ways to do that. One is by setting up somewhat obnoxious 72T schedules. I know neither
Right.
one of us are really big fans of those 72T distributions. But another one would be to have the planning forethought to convert 5 or more years before that planned early retirement date And now you can take out those conversions without any type of tax or penalty. That's
Right.
early, and that can be very tax efficient.
Or do a series of conversions, as you said, because that 5-year little trap, or to close the loophole that was created, as you said, that 5-year rule you're talking about applies individually to each conversion, each batch of conversions. What you were talking about there.
That's
So
right. That's right. And
you
that's
can
different. We
take.
should point out that's different than the
I
5-year
know.
rule. I know we're getting into, yeah. There's two, but people often, you probably get it
I,
all the time, Ed. Like, can you explain the 5-year rule to me? No, because there's not
oh,
the 5-year rule. There's two of them. There's one that we're talking about for accessing converted money early. That one has a separate 5-year clock for each of your conversions. The other one that says, is everything tax and penalty free if you're 59 and a half, has only one 5-year clock from the first money you had
right.
Roth
We're
IRA. So
talking
very
about
confusing.
what you said with the conversion. So if you had the forethought to do these conversions, you could pull from the older ones that have been held for 5 years, and you won't have that problem.
That's right. And it's automatically done by the way it's record kept. So
Right.
if you convert at 45, when you're 51, you could take out that amount. If you convert at 46, the money you could take out at 52 from that, et cetera. So you're absolutely. But I want to turn back, Ed, to the other early, because the traditional advice that is given, I think, like not I think, I know you just said that, I say that all the time, is like, don't use the Roth money until the very end,
It's
right?
too good. It's the best basket of money ever created. Yes.
All right. So help explain to everyone why that's the general advice and why you tend to go that way. And then I want to add a little bit about why maybe there may be certain circumstances where you might not want to follow that typical rule of thumb.
Well, that's the whole point of the topic on this podcast. I showed you one early. The 90-year-old took it out in his mind early. We took it out early for education. So the general rule is this money grows the fastest, because tax-free money always grows the fastest because it's not eroded by current or future taxes. So if you have an account growing, that's the best account, because you keep 100% of those gains. You never have to share it with the government. So in general, that should be the last basket you dip into. So now I'll let you take it. What we gave a couple of situations for
Sure.
gifting, that's a good vehicle, and
Yep.
for things like education.
Sure. And I would say, like, to just level set everyone, what we're really saying here is that as you get older, you may have various different types of money. You may have some Roth money that's available. You may still have, you didn't convert everything, and so you have some money in your traditional IRA or 401k. Maybe you have some money in a joint account or something like that. So you may have different types or pools of money of which to touch. And the typical advice is spend your after-tax money, or your taxable money, or what some people call your already taxed money, like your
Right.
joint account money first. Then after you've done that, spend your traditional IRA money. And then after you've done that, spend your Roth IRA money. That's kind of the rule of thumb that people would say to follow. And what I would say is it's certainly a better path, if you will, than the opposite. It's way better than starting and spending your
All
Roth
right. You
first,
did a
then going
big
to your
setup.
traditional IRA.
You
Yeah.
did a big setup here. I'm waiting for the exception.
All right, I'll get you. So the key point here, though, is that sometimes, many times, don't wait until the very end to use the Roth, because if, let's say, you've spent through all of those other dollars and the only thing you have left is the Roth IRA, your tax rate is going to be 0%,
Right. You
because
won't use the.
that's right, which in theory sounds great, but from a tax planner's perspective, the goal is not to have the lowest tax bill in any one year. The name of the game is to create the lowest lifetime tax bill, or in the case
Right.
of retirement accounts, sometimes the lowest multi-generational tax bill. If you're paying nothing in one year, it means you probably paid too much in a previous year to get it to that 0 point. And so a better way of thinking about this might be, boy, instead, and I'm just making these numbers up, but like, I'm going to take out enough money from my traditional IRA so that I get to the top of the 24% bracket. And then anything above that, I'm going to take out of my Roth IRA,
Okay.
because it'll be tax-free and I'll keep my low average tax rate over time. So often it's not do this first, then this, then this. It's
Yeah,
oftentimes a combination of these different accounts that creates the optimal distribution path.
yeah, you never want to have a year where you waste a standard or itemized deduction
That's right.
or low brackets. So remember, you have
Yeah.
the standard deduction for most people and the low brackets on top of that.
Right. For a married couple now, the first 30,000
Right.
plus of income that you have is tax free. So why would you not want to have at least $30,000 a year of IRA income to eat up that tax-free amount? It would be blasphemous not to. Now, of course, there's Social Security and other things to throw in
Right.
there, but that's the point.
And if you don't need the money, take it anyway and convert it to a Roth.
That's exactly right. Yup, you still can use up that tax efficient amount. So it's not necessarily a matter of never touch your Roth or only spend the Roth at the very end. Sometimes it's a matter of what is the best path to get you to the lowest lifetime tax bill. Ed, any other times when you would see potentially taking the Roth IRA sooner?
If you absolutely, like you said, you absolutely went through all the other assets, or you're in a high tax bracket and you don't want to take more taxable money for some reason, you want to keep your tax bill low for a certain year, so maybe that would be a reason to pull some Roth money out. But in general,
Sure, maybe you inherited an IRA or something like that, and you've
right,
got to
right,
pull out, and your tax liability is already very high, but it's going to be
right.
lower in the future. Yeah, there are all sorts of reasons for that. But I think it's worth, again, reiterating that what we're talking about are largely the exceptions or
Exceptions, right.
the outskirts of the rule. But the general thought, Ed, of course, going back to it is what?
Yeah, hold on to the last, that should be the last pot of money you dip into. It's the best money you'll ever have. The Roth IRA is the holy grail, growing income tax free for the rest of your life, no RMDs, and 10 years beyond to your beneficiaries.
Yeah, and 10 years beyond to your beneficiary after
If you have a
going tax-free to
spouse,
your spouse if you
that's
have one.
right.
Yeah.
So you could be
Yep. So a
talking
great
about
account.
20, 30 years. I just saw a study that we keep talking about these beneficiaries, the kids and grandkids. I just saw studies where it came out a few weeks ago. Most of them, a lot of them, they say may get nothing because the spouse is going to live so long beyond. You forgot about the second spouse, what we're starting
That's
to
right.
call now lateral or horizontal planning before it goes down.
Indeed. Indeed. Well, listen, the Roth IRA is certainly the less taxing account, that's for sure. And we hope that this was not a taxing episode of the Great Retirement Debate for you to listen to. As always, the winner of our debates is supposed to be one person, and that one person is you, the consumer, who is armed with better information, better knowledge, so you can make a better decision for you and your family and your loved ones. Ed, thanks so much for your insights today, and thank you for joining us on this episode of the Great Retirement Debate. We'll see you real soon.